Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, August 31st, 2024. Hey, how you doing? Appreciate you coming to the podcast. I hope this is going to be a good one. I hope it's going to be helpful for you, and hope you had a good week trading. The bulls are back, and are we going to all-time highs? It's definitely possible. We have to keep our mind open for it. We also have to keep our mind open that we might go down. That's just trading. So, listen, the format for the podcast today is first of all, we're going to run the U.S. legal disclaimer. We're going to get that out of the way. We're going to come back. We're going to look at all the trades that I had last week, both on the daily time frames, both on the weekly time frames, trades that are still open, and we'll take a look at when I entered the trade, why I entered the trade, what the setup was, what the confluence of signals were that got me into the trade, where I placed my two different stops, my emergency stop, my end of bar stop, how I am going to take, or how I did take partial profits if the trade went my way. We're going to look at serious resistance levels where prices may stall out, what kind of price action will happen that will get me out of the trade. So we'll talk about when I entered the trade, why I entered the trade, and most importantly, how I am going to manage the trade going forward, whether it goes my way or goes against me. You always have to have a plan. It's very important to have a process, everyone, that before you get in the trade, you know exactly what you are going to do regardless of what the market does. If it does this, then I'm going to do that. If it does that, then I'm going to do this. Process-driven trading is so important in my opinion. It really is. And you're not going to make money on every single trade. You're going to have a lot of losing trades, but the key is that you're patient. You wait for a confluence combination of the indicators to line up. It gives you if you're going long at some kind of level, some type of support level. If you're wrong, you're wrong. Most of the time you're wrong, very small. But if you're right, you have the chance for a large upside trade, and you need those handful of big trades uh, during the year. That is going to pay for a lot of the losses, the little losses that are inevitable that you're going to have, and leave some left over for you. But it's so important, everyone, to get yourself a process that incorporates these principles. There's a lot of different ways to trade. Whether you trade like me or trade like someone else, it doesn't matter. It's all the same. Keeping your losses small and having the ability to let your winners run, which is an important part. That is a difficult part. A lot of people have a problem with getting out of their stops, but on the other hand, there's a lot of people that have a problem holding on to winners. They're both very important. All right, so we'll take a look at the trades on the dailies and the weeklies. We'll see how they're doing. After that, we're going to talk a little bit about trader psychology, just what I just mentioned. Trader psychology is the most important skill in trading, the ability to create a plan and then follow that plan regardless of what the market does. Over the long run, this is what will make you successful as a trader. Good process and following it, and that has everything to do with trader psychology. So we'll cover that. After that, I have gone down through my master watch list last night, and I have identified some potential trades next week, but these potential trades are not where they need to be yet. One of the best things that I've incorporated into my trading is the ability on the weekends to go through, look at different charts, look at different markets, and say, oh, okay, if this particular stock gets down to here, then there'll be a confluence of signals, because there will be, for example, it's at the 200-day moving average, it's the 30 RSI. On multiple time frames, on higher time frames, it has this, and then noting that, marking that, and then next in the coming week, if it does get there, then great, potentially have a trade. If it doesn't get there, do nothing and just wait for another market that you've identified to get where you think that it's a good location based up on support levels, RSIs, moving averages, whatever. I don't have a lot of them this week. As a matter of fact, I don't even have any on the weekly. And that's kind of important to say. If there's nothing on the weekly that got my attention whatsoever. So there's nothing there. Don't do anything. So yes, I have 5 potentials for next week. Some of them are long, some of them are short. They're not where they need to be, but if they do get there, I will definitely consider entering those positions or entering a position. So anyway, I hope this is going to be helpful. I hope you're going to learn a lot. Do my best to make that happen. And if you do find something valuable in the podcast today, I would really appreciate it if you could hit the thumbs up button or subscribe to the channel. Really does help the channel out, lets YouTube know that there's some valuable content here. So I would really appreciate that. So let's get this U.S. legal disclaimer out of the way, and then we'll get rolling. All right, hang time for about 40 seconds. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started on the open positions. This is QQQ, the NASDAQ 100. I did get long QQQ back here on the 5th of August after we hit that big move down. Why? Well, there were a confluence of signals. Now, any one of these signals would have been valid. This is a deep dip buy strategy. And any one of these signals by themselves would have been valid. But as I always say on this podcast, it's better to wait for a confluence of signals, multiple signals. Let me take you through. Let me highlight the black line here. This is a 200-day moving average, major moving average, where a lot of large financial institutions and savvy traders tend to enter positions around the 200-day because it gives them a good line in the sand. On the 5th, during the day, we went clearly below the 200, and then we closed above the 200. I always base my entries on the closing price. It's the most important price of the day. So during that day, we went under the 200, then closed back above the 200. Again, by itself, a valid signal. Additionally, from an RSI perspective, we went under the 30 RSI during the day and then closed back above. Again, either one is valid, but the two of them together is better. Number 3, we have a long-term trend line here that you can see this trend line. During the day, we violated it to the downside and closed back above it to the upside. So those are the signals. I did get long at 435.31. Now, as soon as I get long, the first thing I always do, I have to position size based upon the current volatility. How do I do that? The way that I do it is I take 1% of my capital. Let's say we have a $100,000 account. 1% of the capital is $1,000. Then I take that $1,000 and I divide it by the value of the 2 ATR. Right now it's 1883. It was different back here when I bought it, but at the moment right now the 2 ATR is 1833. So 1% of my total capital, $100,000, 1% of that is $1,000. I divide that by the value of the 2 ATR, divided by 1883. So if I took the trade today, it would tell me to buy 53 shares, okay? The higher the volatility, the lower the amount of shares. If I bought over here for whatever reason, the volatility would have been much less. I'd be buying more shares. So that's why I always say it's important to position size based upon volatility. So I buy the 53 shares, the first thing that I do is I place my emergency stop 2 ATRs below. I place whatever the 2 ATR was below, so that if I have 53 shares and it goes down $18.83, how much have I lost? Well, we just did the math, right? 1%. Now, the good news is that only happens about 5% of the time. The other 95% of the time, if you have a loss, it will be an end of bar stop. So my end of bar stop is really, why did I take the signal? Well, the main one was the under 30 over 30, the under 200 over 200. My end of bar stop would simply be a close below this 200-day moving average. All right, so confluence of signals, why I bought. I positioned size correctly based upon the volatility. I placed my emergency stop 2 ATRs below. My end of bar stop simply a close below the 200-day. So now here you see this line here, this horizontal line. This is my trailing stop level. This is 1.5 ATRs above my entry. So what that means is that if I do enter the trade and I do get to my trailing stop level, now I go into what is called trailing stop mode, which means that now in the future, after reaching trailing stop level, if I have a close below a previous bar's low, I'm going to get out of half of my position. All right, so just because you get to trailing stop mode, nothing happens. It's just that now you're in that mode. So in the future, if you have a close below a previous bar's low, you get out of half. All right, so the emergency stop, the emergency stop, the 2 ATR emergency stop, the end of bar stop, which would be the close below the 200-day moving average, going into trailing stop mode. These are all defensive moves. It really, what it means is I'm taking action if something goes against me. Hitting the emergency stop, closing below the end of bar stop, closing below a previous bar's low after reaching trailing stop level. These are all defensive moves. So let's talk about offense, because it's important that you play offense as well in defense in trading, in my opinion. So the offensive part comes where I take partial profits, 10% of the remaining position that I have, if the price moves the value of 0.45 ATRs from the previous bar's close. So let's just take the current position that I'm in right now, 476.27. So I take 476.27 and I add the value of the 0.45 ATR. Today it's $4.24. So I add plus 4.24. That is going to be my first profit target on Monday or Tuesday, because Monday's market's closed. So that will be my first profit target, 480.51. And if it reaches there, I'll take 10% of whatever the remaining shares I have going into that particular day. So that's my first profit target. Then I take my first profit target, which is 480.51, add the 0.45 to it again. 484.75 is my second profit target. Then I take my second profit target, I do it one more time, and my third profit target for Tuesday will be 488.99. So that is what I do every day. Closing price, add the three profit targets to it, and then if they get there, 10% of whatever shares I have remaining going into the day. So you can see on the day that I bought here, 435.31, next day moved up strongly, hit 2 profit targets. Reduce my position size, lock that in, the market can't take it away from me. Next day we moved down, no profit targets. Next day, 2 profit targets again. Then we moved up a little, no profit targets. Here, hit another profit target. Next day, nothing. Here, hit 2 profit targets. Next day, nothing. Another profit target. And then we had this bit of a down move. So let's start again. Under 30, over 30. Rejection of the 200-day moving average. Rejection of the long-term trend line. I got long here at 435.31. I placed my emergency stop 2 ATRs below. Again, my experience, only about 5% of the time am I going to hit that. The other 95% of the time in this particular setup would just be a close below the 200-day moving average. Place my 1.5 ATR trailing stop level up here, and away we go. Next day, hit some profits. Next day, no profits. On this particular day, on the 12th of August, I got to trailing stop mode, which now just means I'm in trailing stop mode. If I get a close below a previous bar's low, I'm going to get out of half. We just went up, 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 continue to take profits, partial profits. Here on the 22nd of August was our first close below a previous bar's low. And so in this case, I took off half of the remaining shares that I had for a gain of 8.68%. And then we had this move down and a little bit up on Friday. And currently, the remaining shares that I have up 8 point, yeah, no, I'm going to do that one again. Yeah, 8.57%. So just about where I took off half when I had the close below the previous bar's low. So the remaining shares up 8.57%, really good trade. Here we have this long-term trend line that is now resistance above us. You can see when we made the highs 7-8 days ago, that's right where we ran into those and failed. Going forward, if we move up into this again, there's probably going to be some resistance levels there as well. Now, I'll just continue to take profits. If we move up, I'll continue to take partial profits. If we get to a 65 RSI level, then another stop comes in, a trailing stop comes into play, which is the 5 EMA. If we reject the 70 RSI, then I'll take off half of the remaining shares. And then if we have a close below previous bar's low after rejecting the 70 RSI, then I'll be completely out of the trade. So a lot of rules. I do have a lot of rules. I've been trading for almost 29 years. Every rule that I have is for a real reason, whether to the upside, to the downside. It may sound complicated, but it's really not. And by the way, you know, I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I have taught people from all over the world. I teach a 15-hour one-on-one course where I take you through all 7 of the different strategies that I use and show on this podcast. Um, I really think you would like the course. You're going to learn a lot. You're going to learn a lot from the experience that I've had over the last 29 years. And we go through things step by step. We do all sorts of simulations so that I really know that you know how to use these strategies. And these strategies will serve you well in the long run if you use them correctly. So if you're interested in studying with me and doing the one-on-one 15-hour course, my email is in the link in the description. Just send me an email. We'll get things, we'll start to discuss things and hopefully become my student. And you're going to learn a lot and you're going to have a skill you can use for the rest of your life. So, okay, so Q's remaining shares up 8.57%. Let's go to UNG. UNG is another long position that I have here. I did enter this position back here on the 6th of August at $13.09. You see this highlighted little green bar here. What is that? This is called a bullish abandoned baby, and this is one of my favorite new strategies that I use and have used with very, very good results. Of course, they don't always produce winners, but they do more times than not, and that's about the best you can ask for in trading. But the reason I highlighted this bar green is because the previous day, you see how we gapped down? So for whatever reason on that particular day from the previous night's close to the open, it gapped down. There was bearish sentiment. Well, the very next day, we gapped up. So we went from being, the sentiment was bearish to immediately bullish. Well, when this happens, and then you look out into the future, when you get a bullish abandoned baby like this, where it gaps down and then immediately gaps up, more times than not in the future, that market will be higher. So it gapped down, gapped up. When it came back to fill the gap, I got long here at $13.09. Now, this is different than the Q trade that I just showed you because I have different strategies and I have different exit strategies as well. This one is quite simple. I entered here at 1309. I place a 2 ATR stop below me, and I place a 4 ATR profit target above me. That's it. One of the two things is going to happen. I'm either going to lose 2 ATRs or I'm going to make 4 ATRs, which is good. That is proper trading. That is a asymmetrical risk to reward ratio. If I'm wrong, I'm gonna lose 2 ATRs. If I'm right, I'm gonna make 4 ATRs. And in my experience with these abandoned babies, if you get them at the right spot, almost 70% of the time, maybe even a little higher than 70% of the time, I hit that 4 ATR profit target. 30% of the time, I lose 2 ATRs. but about 70% of the time, in my experience, I make 4 ATRs. That's a pretty good proposition. So you can see as soon as I bought here 1309, it went my way immediately, got kind of close to the 4 ATR profit target, but then we moved down, and actually last week at one point went negative on the trade during the day at least. So this particular trade is currently 2.09%, which I'm definitely grateful for. Would obviously would have been nice to get up here to the 4 ATR, but hey, it could still get there. But this one's quite easy. 2 ATR stop, 4 ATR profit target. If you'd like to learn more about abandoned babies and island reversals are very similar. Go to my YouTube channel. I have a good video there about abandoned babies, island reversals. Take a look and it will explain more. So this particular trade on autopilot, but currently up 2.09%. Next trade on the daily is Microsoft. Okay, well, I got long here Microsoft on the 9th of August. Why? Again, this is a deep dip buy strategy. Well, the previous day we closed below the 200-day moving average, and the next day we closed above the 200-day moving average. So I got long at 406.02, position size correctly, placed my emergency stop 2 ATRs below. My end of bar stop simply going to be a close below the 200-day moving average. Place my 1.5 ATR trailing stop level above, and as it moved up, took some partial profits here, took some partial profits here, got to trailing stop level, which means now in the future, if I have a close below a previous bar's low, I'm going to get out of half. Well, that happened here on the 22nd of August. We had our first close below a previous bar's low. After reaching trailing stop level, I took off half of the remaining shares that I had left after taking partial profits for a gain of 2.68%. Then here on the 28th of August, during the day, we went below the 200, but we recovered and closed back above. Had this closed below the 200-day moving average, what would I have done? I would have gotten out of the trade, right? Because that is my end of bar stop. And but it did recover, close above. Next day went up nicely. I hit 2 profit targets, thankfully. And then it reversed back down, still positive on the day, and then we were up 4.02%. I did hit 1 profit target because the 0.45 is 3.47, and we went up 4.02, so I took another profit target off. So as long as we hold above this 200-day moving average, I'm in. Taking partial profits. Again, if we get to a 65 RSI level, then the 5 EMA comes into play. If we reject the 70 RSI, then we do stuff there as well. But again, like I said at the beginning of the podcast, you have to have if-then statements. If it does this, I'm going to do that. If it does that, I'm going to do this. And why can't I get this to work? Let's see. Sorry about that. There we go. So this particular trade currently up, the remaining shares up 2.6%. But again, having if-then statements. If it does this, I'm going to do that. If it does that, I'm going to do this. I can't control this market whatsoever. I wish I could. If there's a way, please let me know. But in the meantime, all I can do is have a plan and follow that plan. Obviously, I would like this to go up, be great, but it doesn't have to. It could come down. And so right now, it closes 1 penny below that 200-day moving average. I'm just done with the trade, and I look for another trade. All right. So up 2.6%. Pfizer. Okay, so far we've done deep dip buys, abandoned babies. This is a different type of strategy that I use here. It's called a higher low V2. Again, this is something that I teach in my one-on-one course. Really love this. But a higher low V1 or V2 happens within the value zone. The value zone here is defined by this green line and this green line. Anywhere below this green line and above this green line is called the value zone. And I generally like to buy in the value zone, sell above the value zone, or buy below the value zone and sell in the value zone. So the first rule for a higher low V1, V2 is we have to close below the lower value zone, below this green line. Did we close below? We certainly did. The second rule requirement is that we have to rally into the value zone. Did we rally into the value zone? We did. And then we have to have a bit of a pullback, and then we have to have what is called either a V1 or a V2. And if you'd like to learn more about V1s, V2s, just go to my YouTube channel in the lessons playlist, and you will find a good video there on V1s, V2s. So this is a V2. A V2 consists of 3 bars: bar 1, bar 2, and bar 3. And the requirement is that bar 2 has to go below the low of bar 1's low, which it did, and then it has to close above the close of bar 1's close, which it did. And again, this low here, this low that was put in here is higher than this low. So this is called a higher low V2. So I got long on Friday at 29.01, essentially where it's at. It's at 29 because I bought right at the close. I placed my emergency stop how far below? 2 ATRs. But my end of bar stop on this type of trade is a close below halfway of the washout bar. Bar 2 is the washout bar because it washed out or went below bar 1's low. So going forward, of course, if it just goes crashing down on Monday and it hits my 2 ATR emergency stop, I'll get out immediately and I'll lose 1% of my account. But again, doesn't happen very often. But the secondary stop loss would be if we close below halfway of Thursday's bar. This is right here about halfway, about 28.65. So Monday, if we close below here, I'm out. I'm done with the trade. This line up here, my 1.5 ATR trailing stop level. So if we get there, I just go into trailing stop mode. And if it moves up, I will take partial profits. Right now, it's $29. The value of the 0.45 ATR is 25 cents. So on Monday, if it gets to 29.25, I'll take 10% of the shares that I have off. If it goes up 50 cents, then I'll hit 2 profit targets. If it goes up 75%, I'll hit 3, and I redo them every day. So right about even on this trade, and but I really like these trades. In my opinion, it's important to have different strategies that you use, not just deep dip buy. Deep dip buy is great, but you want to have other strategies as well because we're not always down in deep dip buy area. So anyway, we'll see. It offers good risk to reward ratio, had good price action, and that's what got me in the trade today or yesterday. All right, so that's Pfizer. Now let's go to Tesla. All right, Tesla is a position that I purchased here on the 28th of August. Why? Well, you see a green box down here. Whenever you see a green box, that's that's the location that I'm interested in buying. And the green box is there because the 200-day moving average is here. I bought and went long on Tesla at 206 even on the 28th of August because during the day we went below the 200. No more sellers down there, recovered. I got long here at 206. This is called, again, this is a deep dip buy, stocks trading strategy, because the market showed that there were no more sellers under the 200, and it gives me a pretty good risk to reward ratio above this. As long as the price closes above this 200, I'm in the trade. I'm long, I'm bullish. If it closes below the 200, I'm simply out of the trade. So I got long at 206. Again, I position sized correctly, placed my emergency stop 2 ATRs below. Only 5% of the time in my experience it gets there, but it happens. My end of bar stop is going to be what? It's simply going to be a close below the 200, giving myself a good risk to reward ratio, entering the trade after I saw that this level was rejected. This line up here, what's that? My 1.5 ATR trailing stop level. If I go there, I go into trailing stop mode. So when I bought at 206, next day it went up nicely, hit some profit targets, and then it went up again on Friday where I hit more profit targets. So I took 10% of the position off here. I took another 10% of the position off here. I like to scale out as the market is going my way. If we get to trailing stop mode, then I go into trailing stop mode. But if I get to trailing stop mode, then I'm in trailing stop mode, and then if I have a close below previous bar's low, I will get out of half the position. So this particular trade doing well, up 3.36% in 2 days. And then last but not least on the dailies is VIX. I did get long VIX. It's slightly underwater. I did get long VIX back here on the 19th of August at 44.70. Why? So this is an entirely different approach. This is what is called a bullish order block. And a bullish order block, you can see this is the green. Anywhere in the green is the buyable area. A bullish order block is your lowest bar close before you change market structure to the upside. And you can see we changed market structure to the upside back here on the 24th of July when we took out this swing high. Then we had this huge rally in VIX, unbelievable. And we've come all the way back down. But we are down into the buyable area. So I got long 44.70. Of course, I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block, which is 42.60. So this particular trade currently down a little bit, about 0.83%, which is fine. But I like having this VIX position because, for one, we are in the legitimate buyable area, and it gives a little bit of hedge to the long positions that I have. So this one down 0.83%. Okay, so just a review on the open positions on the daily. Qs, the remaining shares I have up 8.57%. UNG, the abandoned baby, up 2.09%. Microsoft, remaining shares that I have on the deep dip buy, up 2.6%. Pfizer, the higher low V1, basically exactly even because I just got into that on Friday. Tesla was a deep dip buy, up 3.76%, and VIX, the bullish order block, down 0.83%. So those are the dailies. Let's head over to the weeklies. I like to trade multiple time frames, and if you've been watching the podcast for a while, or last week, I did cover Apple, that I was looking for a short on Apple. Now it looks pretty strong. Why would I short Apple? Well, for a couple reasons. We broke structure to the downside. See the swing low? When we took out that swing low, that changed market structure to the downside. And then this is a bearish order block. I just talked about a bullish order block on VIX. This is a bearish order block. This is the highest level close before we change market structure. So when we come back into that bearish order block, or this red box here, that is an area where more than likely we will head back down. And I drew this line here at 229.20. Why? Because it was, see the big down bar we had, the very big down bar we had? If you have a big down bar like this, and then you rally back up to about halfway, you're going to find some resistance. So that's exactly what we did on Friday. We went above halfway and then closed below halfway. So two things are going on. We rejected halfway of the big down bar, and we're also in the bearish order block. So I got short here 228.80. It's 229 right now. So yeah, basically break even, right? I'll do the numbers after, but I mean basically break even because I just took the trade. So I got short here 228.80. I placed my because this is a short, I placed my emergency stop 2 ATRs above. My end of bar stop is simply going to be a close above the high of the order block, 232.90. This line here is my trailing stop level. It's 1.5 ATRs below my entry. And then, of course, if it starts moving down and moves the value of 0.45 ATRs, I take off 10%, right? If I get to trailing stop level, then I get out of half if I have a close above a previous bar's high, because this is a short position. So Doesn't matter, right? I was patient. I waited for what I wanted this market to do, and what I wanted this market to do was rally back up into the bearish order block, reject halfway. It did it. So that's why I took the trade. Is it going to be a profitable trade? I have no idea. I don't know. I don't have any control, but I know exactly what I'm going to do. If it closes above 232.90, I'm out of the trade. If it gets way up here to my emergency stop, I'm out of the trade, and I know how much I've lost, right? If it moves down, I'm going to take partial profits as it goes my way. If it gets to trailing stop level, then I'll go into trailing stop mode. If it gets lower and gets into the 35 RSI range, then the 5 EMA will come into play for that. If it rejects the 30 RSI to the downside, then I do stuff there. So regardless of what it does, I know what I'm going to do. And so we'll just see. So anyway, just about break even on this Apple trade, on this Apple weekly trade. And by the way, these are weekly bars, so I wait until Friday to make my decisions, unless I hit profit targets during the week. Then I take action there. But as far as getting out of the position fully because of a stop, that's at the end of the week, unless I hit my emergency stop. All right, and then Disney, I got long Disney here back on the 9th of August. Why? Well, this is a deep dip by everyone. During the week, we went under the 30 RSI and then closed above the 30 RSI. So I got long here, 85.90. I placed my emergency stop 2 ATRs below. My end of bar stop is going to be a close below 82.95, and I'll show you why I picked that price. I'm looking at the monthly bars now. As you see the black line, this is the 200-week month moving average. And so if it closes below that, I am going to get out of the trade. So it's doing well so far. I know exactly what I'm going to do. Emergency stop 2 ATRs below, end of bar stop, close below 82.95. It already moved up. I took some profits. Line here at 93.20. That is my trailing stop mode. Not quite there yet, but if I get there, then I go into trailing stop mode. And so this weekly trade on Disney doing pretty well, up 5.08%. So all in all these trades have worked out pretty well, except for VIX for a very small loss, and then the new trades, Pfizer and Apple, which are basically about break even. So we use higher low V2s in that equation, or in these different trades, abandoned babies, and deep dip buys this particular week. All right, let's talk a little bit about trader psychology before we move on and look at the potential trades for next week. This is from Linda Raschke, very famous trader and educator and author. I've met her. She's very nice. You can follow her at Linda Raschke on Twitter. And I think this is a good channel. Learn a lot there. She's one of the best traders out there and educators. Let's see what Linda has to say. Eventually, execution beats luck. Consistency beats intensity. Curiosity beats smart. Kind beats clever, and together beats alone. I agree with all of these. I would say the first two are the most relevant to trading. Execution beats luck. You can be lucky. You can just put a position on and immediately goes your way, and that feels fun, right? I've done it. That's great. That's really fun. But you kind of have to look at it as luck. What she's saying here in regards to trading, execution beats luck. Instead of just gunslinging and putting a trade out and hoping it's going to go your way, be patient, wait for that setup, win or lose, follow your process over time. That execution of the process is going to beat luck, and consistency beats intensity. What does that mean? Well, it can mean a lot of different things, but to me, in regards to trading, it means that consistently following your process, even if it's not large position size, just take the slow and steady approach of trading, beats the intensity of being really big sometimes, winning big sometimes, losing big sometimes. The tortoise and the hare scenario of get yourself that process, follow that process. It doesn't have to be fun and exciting. Trading really shouldn't be fun and exciting. It should just be a process that you follow. Listening to this podcast, you probably think I'm obsessed with process. I am obsessed with the process. I deal with so many traders. I see so many traders have so many problems, having so many um, biases about this market can't go higher, this market can't go lower. And instead of having a process that they just follow, they think they know better, and then the market rolls over them and they don't know what happened. I'm just pleading to everybody. If you're having a problem with trading, if you're in a drawdown, if you're not in a good space in your trading, get back online, get back on course, and get yourself a process and just follow it and follow it. That's the key. You have to follow your process. So execution beats luck in trading. Consistency beats intensity. I like these two, but as far as trading, I'm not sure, but curiosity beats smart. That's nice. Kind beats clever. I think kindness always wins out, and together beats alone. I think that as well. And we're doing this together, right, on the podcast. And which reminds me, if you have any questions about anything I've said in this podcast or need clarification, just put it in the comment section. I'll do my best to get back to you and answer your question. All right, let's get back to. All right, here we go. As I mentioned, I don't have a lot of setups this week. Just the market as it is not offering a lot of setups, but I do have 5 potential setups here. And I do want to point out that all 5 of these could potentially trigger on Tuesday, for example. Does that mean I would take a position in all 5? No. I like to pick only the best setup of any particular day. And I grade them. I give them a score. If they have 1 entry signal, maybe I give them a point. If they have 2, then that gets 2 points. If they look better on the long-term time frame, I look at long-term time frames as well, then that's also a score. I look at the relative strength. As a matter of fact, on Apple, one of the reasons that I did get short on Apple was it was down yesterday when the market was up. So I factor that into my equation. So, if all 5 of these trigger, I have to look at which one has the best risk to reward, which one has on multiple, does it look best on multiple time frames? How many confluences, combinations of entry signals happen in that particular day? What's the relative strength of that particular market compared to the market as a whole? So the devil's in the details in narrowing down to the one that has the best report card. And again, in my one-on-one training, this is what I teach my students how to do this, and it really makes a difference. So again, these are not where they need to be yet. That's the key in trading, is just being patient and waiting for the market to get to where you want it to get to, waiting for that perfect pitch across the plate. And if it doesn't get there, then just don't, if it doesn't, for me, if they don't get there, I'm not going to do anything. AGQ, this is double leverage silver. Well, you see a green box down here. That'll probably give you a clue that this is where I'm looking to potentially get long. It's quite a long ways away from there. So the chances of this coming down to the 200 next week, probably not very good. But if it does get down there, then I'll consider taking the trade. I mean, look over here when we danced around and played with the 200. Close under the 200, close over the 200. That would have been a legitimate trade. Plenty of areas up here to make money on that trade. It did respect it. Doesn't mean it's going to respect it this time if it gets there, but if it does get there, it's more likely to respect it this time if it respected it last time, but not always, but it helps. All right. So yeah, I mean, the 200-day moving average is 32.21. We're at 35.27. I don't, probably it won't get there, but if it does and shows me that it rejects the 200-day moving average, then that shows me something. The market has showed me something, and more importantly than that, hopefully it gives me a good risk to reward ratio. Above. If it rejects the 200, closes above, I'm in. Next day, if it closes below, I'm out. That's just all there is to it. If it stays above the 200 and moves back up, I'll continue to take partial profits along the way. based upon what my process is telling me to do. So not likely that AGQ is going to get to the 200, but if it does, I will consider it, and we'll just see what happens. Carnival, CCL, Carnival Cruise Line. Okay, well, this one has a lot more potential to get to the 200. You can see, we had nice deep dip buy down here, worked under 30 over 30, and just a nice move up. So the 200-day moving average is within striking distance. It's 1618 right now. We're at 1650. So next week, certainly we could go down intraday, poke our head below the 200, and then close back above. That would be a legitimate signal. See the big bar here we have on the 23rd? Big up bar. Well, if you have a big up bar like this, and then you have a pullback to about halfway of that bar, you're going to have some inherent support there. What I like is that this 200-day moving average is a little higher than halfway, but you could have the price come down, test that halfway of that big up bar, and then close back up and close back over the 200-day moving average. So this makes sense to me. You have a lot of support here with the 5 EMA, the 20 EMA, the 200 EMA, the 10 EMA, halfway of this big bar, and then like I said, most importantly, the 200-day moving average. So this has had a large move up here. Pullback is to be expected. A pullback and rejection of the 200 with a good risk to reward ratio might be a good entry point. So we'll just have to wait and see. But again, let's take a look at the next signal. FDX is FedEx. Okay, I have a red box here. Probably means I'm looking for a short. This is very similar to Amazon. Look back here on the 31st of July was our highest up bar close before we had a structure change to the downside. And then if you rally back up into this bearish order block, this is a potential place to short. Now, the big down bar we had here on the 1st of August, look, I'm halfway, $300.80 is about halfway of this big down bar. That halfway coincides with being at the bottom of this bearish order block. So next week on FedEx, the way that I'm looking at this is that if we head back up, reject that halfway, that 300.8, we would have rejected the bottom of the bearish order block and rejected halfway of the big down bar. Then I potentially put the short on. I'd place my emergency stop 2 ATRs above, and then my end of bar stop would just simply be a close above the high of the order block. So that's the potential short there on FedEx. But again, I really want to see it reject $300.80. Google. Okay. So I've been talking about Google for a long time. Excuse me. Boy. I had a bit of a flu last week, and I just haven't been able to kick it. So you can probably hear it in my voice. So apologize for that. But this is a good example, everyone, of just waiting and waiting and waiting for your market to get to a legitimate level. Well, there's a couple legitimate levels here on Google. I just talked about a bearish order block. Well, this is a bullish order block. This was your lowest bar close back here on the 19th. This was your lowest bar close before you change market structure to the upside. And so if you come back down into this bullish order block anywhere in this green area, this is a pretty good place to buy. I mean, look, happened right here on the 5th. It got to that green box and then it bounced. So this is a legitimate area, but what I'm really looking for is a rejection of this 200-day moving average, which is about 156.18. We'll take a look, everyone. Look at the perfect confluence. The top of the the top of the bullish order block coincides exactly with that 200-day moving average. So there's your confluence of indicators. Those are your confluence of levels. If next week we come down, and we could, I mean, look, Google has not been strong compared to the rest of the market. So if the market gets weak, there is a likelihood, in my opinion, that we'll come down and either bounce at that 200-day moving average, intraday reject that 200-day moving average or close under and close over that 200-day moving average. This is a very interesting trade for me, but I've been talking about it for several weeks. Do you see what I'm talking about as far as just waiting, identifying the levels, identifying the confluence of signals, and then waiting for it to get there? It might just take off and I'll never get it, and that's fine, right? But if it does come down here, buying Google at a 200-day moving average, if you look back in history, is a pretty good thing to do. And it dovetails really nicely here with this bullish order block as well. So again, this would be a deep dip buy down here to the 200. And I do want to mention, I've talked a lot about deep dip buys today, and it really is a great strategy. If you would like to learn how to trade the deep dip buy strategy, I have a really good online course available at udemy.com. It's very affordable. I take you through step by step exactly how to trade every scenario with a deep dip buy. The video is 9.5 hours, so it's a lot of content there. And I think it has 4.9 stars. I've sold so many around the world, and it's a very, very affordable way to get started. Obviously, the one-on-one courses are more expensive, but you get me for 15 hours, right, one-on-one, and I teach you all 7. But as far as getting started with learning one strategy, the deep dip buy strategy is probably the one that I would recommend, and that's very, very affordable. So the link's in the description if that's of interest to you. Okay, so Google, wait and see. If we reject the 200-day, I would be very, very interested in that particular trade. And then last but not least is United Airlines for a short. Now, the 200-day moving average is above us. That is now acting as resistance. But what's more important to that at the moment, which increases the chances of this trade, is you see the gray line here? This is the 50-day moving average. Well, the 50-day moving average crossed under the black line, the 200-day moving average. This is called the death cross. I know, not a nice name, but this is a death cross. So what I have noticed is that whenever you have a death cross to the downside, very often, for some strange reason, when that happens, you rally up. This is supposed to be a bearish indicator, and long term it is. But in the short term, if you have a 50 crossing under the 200, then what I have noticed is your first rally to the 200 usually fails and goes down. So that is what I'm looking for. We've had the death cross, but I still need to wait for a rejection of the 200-day moving average here. And so Tuesday, if we went above the 200, but then closed below the 200, that would be my short. I would position size, place my emergency stop 2 ATRs above, and then my line in the sand for the trade, my end of bar stop, would just simply be a close over the 200-day moving average. So it might just head back down here, then I'm not going to get it. But again, it's about waiting for what you want to happen, and what I would want to happen to consider taking this trade would be us to continue up, reject that 200-day moving average, giving me a good risk to reward ratio. I want to, let me point out AMD here. I took this trade, exactly same trade. Look, and I got stopped out for a very small loss, unfortunately. But see the black line, see the gray line, see how we crossed it crossed under. Then I shorted this rejection of the 200-day moving average. And then the next day it closed barely above the 200-day moving average, got me out of the trade, and then look what happened. So I definitely had the right idea. I just got stopped out, unfortunately, but it happens. But again, 50 crossing under the 200, rejection of the 200, that was my short, and I followed my rules, which got me out. But you can see that in this particular scenario, when you have the death cross, when you have the 50 cross under the 200, the first move back to the 200 was about all it had before it headed back down. So you can see on United Airlines now, we're in the same situation. So those are the setups for next week. Sorry, I don't have more, but really, based upon what the market's done, there's just not a lot of setups. So I just have to be patient and wait for one of these, and then just manage the current trades that I have, which are, very glad that they're doing well. So I hope this was helpful for you today and that you learned something of value. And if you did, if you could hit the thumbs up button, share the podcast, subscribe to the podcast, or subscribe to the channel, I really, really would appreciate that. I hope you have a good long weekend for Labor Day. Just want to reiterate, get yourself a process, everyone. Follow that process. That will help you along your trading journey. I always like to leave off with, please try to go out and do something nice for someone today. You know, if we did one nice thing for another human being every day, it would make their lives better, it would make you feel good, it would just make the world a whole lot better place. If you could also go out, try to do one nice thing for an animal each day, you know, that's good karma there, right? I mean, we appreciate random acts of kindness. Animals appreciate random acts of kindness too. I was raised with many animals, so I'm very close to animals. And I know this. So, you know, if somebody does it for you, you appreciate it. So why not go out and do something for someone else? So thanks again for coming, investing the time, everyone. And like I said, hope you have a good rest of your weekend. And God willing, I will be back next week and we'll see how these positions are doing. But thanks again, everyone. On the way out here, I have to run the U.S. legal disclaimer. And again, if you have any questions, comments, just leave them in the comment section. I'll do my best to get back to you. All right. Take care, everyone. Thanks a lot. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.